My first guest, though, says, listen, we've endured 3 bear markets in just a few years, so maybe there's a lot more room to the upside. Let's bring in now former CIS for Wells Fargo and a Lutho Group, Jim Paulsen. Jim, my man, look at you. You look great. Look, I mean, retirement's doing, semi-retirement's doing it pretty well. I got to try that. Let's talk about this market. A lot of anxiety about this rally. No one wants to believe it. What are your thoughts for people who still aren't sure?
Well, I think there's some really good things around this, and I think it's more of a sustainable secular bull than it is, a short-lived event. We're only really a little over 1 year into a new bull, if you think about it, Charles. You mentioned we had a bear market in 2022. We had a 20%er in 2018, a 34%er in 2020, 26% in 2022. That's pretty rare to have 3 bears like that in that short of a period of time. And I hardly think that that's the kind of lead up you get to a market which is bubblicious or overdone. The S&P 500 right now is, what, 9% higher than it first was 27 months ago? So it hasn't really been on fire. I think there's some good things, though, here. I think we've got cultural mindsets. I don't mean investor sentiment, that ebbs and flows, but things like consumer confidence, small business sentiment, even CEO confidence index, they're all still pretty low, pretty modest, pretty cautious, which is a good thing because it means if you improve cultural mindsets, it's going to run right through stocks. I also think we have a lot of money on the sideline yet that's sitting in safe haven assets. In the retail sector, retail money funds are 8.5% of disposable personal income. That's an all-time record high. Right. And they're probably feeling good about their 5.5% returns, but if the market keeps going up, some of that's going to come back in.
There's no doubt about that.
And then policies.
Yeah, I'm sorry, Jim. There's no doubt about that. I mean, I'm on the same page with you, but I wanted to delve into something I saw in for today, that the Fed made history twice. It's pretty incredible because this feels like a new Fed. I don't know if it's a new paradigm for the Fed, but this feels like a Fed that's creating its own rules.
It is. If I look back to post-war history, basically, Charlie, a chart of inflation rate, and I looked at all the periods where inflation went up, and almost every time when the inflation rate goes up, the Fed's raising rates consistent with it. And then when it goes down, they cut rates consistent with it. This Fed did exactly the opposite of that. When the inflation rate went from about 1% to 9%, the Fed held the funds rate at 0 the whole time until it got to about 8.5%, only right at the end. And when it went down, it raised rates the whole time. We've never seen that in post-war history, where the Fed is easing during inflations and tightening during disinflations, which puts them into a whole new, unique stratosphere of whatever they're trying to do with monetary policy. I think, though, what's interesting to me, if you have a Fed that goes off and does something completely different than we've never done before, both on the way up and the way down with inflation, you think we'd have all kinds of issues. But the reality is we haven't. Yeah. We've brought inflation down without Fed. We created a sustainable advance here. We got productivity and employment and profits coming back. I don't know. The Fed just seems more and more irrelevant to me than relevant. One more point I'd make. If you're waiting on bated breath for when the Fed's going to cut rates, I'd say I don't know if it's important. I mean, since the Fed has raised rates from essentially 0 to 5.5, the S&P 500's up 25%. So I don't know if they've mattered. Yeah.
You know what? It feels like that way more and more, which I think would be a good thing. I'm so tired of a market, the tail wagging the dog, so to speak. Jim, it's good to have you back. You look great, and we always learn. We still learn every time you come on the show. We appreciate it.
Thanks for having me so much, Charles.
Thank you.